the semester. This is the second time around for the seniors this semester. They'll be joined by their junior proteges. They'll be joined by their You like it when you hear your own voice? I don't. All right, Robbie Metcalf, first presenter of the day. Robbie, want to bring your mentees along and introduce them?
Yeah. Alrighty. Hello, everybody. My name is Robbie Metcalf. I'm a senior in the AIM class. I study finance information systems, and you're my mentees.
I'm Andrew Dietrich. I'm a junior in the AIM program covering financials. I'm Joe Vetrano. I'm a junior in the AIM program covering international financials.
All right. So today we'll be pitching Manulife Financial Corporation, ticker MFC. They are the largest insurer in Canada, and they serve about 1/3 of all residents there. They engage in the provision of financial protection in wealth management products and services, operating in 3 different regions, being Canada, the U.S., and Asia. So on to my recommendation. Overall, the company has made significant changes in their operations and how they operate and to enhance their competitive advantage over their peers. So this strategy has stemmed from diversifying their revenues as a past dependency on life annuities and that more traditional insured kind of business model. They've switched that over and they're searching for more of a millennial customer base to grow new business value. We've seen this come through online services as well as different wealth management solutions, and that's through their online platforms. And we've seen a reduction in their efficiency ratio, which is a metric of their revenues as a percentage of, or their expenses as a percentage of their revenues, dropped from 60% in 2015 to 50% in 2019. Further, the company right now is significantly undervalued to where they usually trade. Volatility in their share price in the recent years has caused investors to overlook the growth potential of the company, leaving their shares trading at that attractive discount. So their next 12-month PE is currently trading 1.5 standard deviations below their 10-year historic average of about 10. And their price to tangible book next 12 months is trading about 1 standard deviation of their 10-year average. Then going on to my investment thesis. So our first driver is the reduction of their legacy book. So they wanted to reduce this side of the business. So this is the more looking for like baby boomers and collecting those annuities on an annual basis, which only has so much more potential going forward. So they wanted to transform that, and they got into that business earlier. And they had volatility in their share price coming from this, as they've had to recognize a lot of these reinsurance sales. So it's put an expense on their company. However, they've made a goal of creating $5 billion in excess capital by 2022. And as of most recent quarter of Q2 19, they announced they already had captured 86% of that expected goal, with ambition to completely go way over that going forward. And that, in addition, having an excess capital has allowed them to maintain $25 billion of capital over the super advisory target, which has allowed them to maintain a LICAT ratio, which stands for Life Insurance Adequacy Test ratio of 144%, which is in the lead among their peers or tied. My next driver going on is their digital customer leader and their digital capabilities. So from this excess capital they've been able to invest in their own team of engineers to create an app. So they launched this brand new banking app, in addition to other online services they already had over the past couple of years. But it's able to take like different credit scores and different information about the person that's looking for a claim in a matter of minutes, which is not something that you've typically seen in the insurance business. A lot of those kind of companies have been in more of the dark ages in terms of technology. And my company, Manulife, has been able to set an exact expectation for this. So they predict of over 1 million of costs saved annually by 2022. and they've already captured 70% of this, which will translate directly into their bottom line, helping their earnings per share growth. Additionally, going off this digital solution, so they've had an historic expense CAGR of about 9%, which is extremely high. And in 2017, they got that down to 3%, partially because of this technological driven idea that they've been moving forward with. And as of 19, they've gotten that expense CAGR down to 1%. And then my last driver going to high potential businesses. So when looking for his company, I kind of was looking for a bank or, some financial service company that has the potential to grow, even given down like macro guidance and an economy of low and negative interest rates. So this company has been focused on growth drivers that will provide that upside even in a down market. So Asia represents about 35% of their earnings in 2019, compared to only 20% in 2008, and this kind of shows that new business value that they've been able to grow over there. Moreover, there's about 1.4 billion today, or 1.4 billion people in the Asian middle class as of today, and that's forecasted to grow to 2.8 billion by 2025, allowing the Asia community or middle class to represent 60% of the world, or 60% of the world's middle class, and that comes with demand for insurance products, new customers, wealth management solutions, and more. In addition, they've been in Asia for over 110 years. So you see a lot of companies coming out saying we have a ton of growth potential being in Asia, and that really doesn't mean anything. You have to have multiple economic cycles of experience in an industry to really call yourself a player, and prove to investors that you can actually operate there. So then going on to my valuation a little bit, the dividend discount model, they pay a dividend of about $1 yielding 4% annually, which is very impressive. So I used dividend discount model in that sense. They used a PE multiple and a price to tangible book value multiple, giving me an upside of $25.66, representing a 35% upside. And then I'll hand it off to Andrew to cover the risks.
Yeah, so just to cover 3 risks here. Number 1 being investment-related income. So Manulife derives 28% of its income from investment-related securities, primarily debt securities. That's going to expose us a little bit to interest rates movements around the world right now. It's been tough to get a return out of the low environment that we've been seeing. It's going to be a short-term headwind for us. Onto our second one, which is going to be lower lifetime variable annuity cash flows. In here, it's also going to be affected by interest rates, drops in interest rates, along with some general equity exposure that we see, so just some inherent market risk there. And then our final one, United States political risk. Every Democratic candidate right now is talking about moving from private insurers to public ones, or just moving predominantly some members over to public, being Medicare and Medicaid as some examples there. And so that opens us up to a little bit of exposure to if one of those candidates would take office. So those are risks.
And then covering management a little bit, our CEO, Roy Gori, has been inside Manulife's business for a long time, but he took over as President and Chief Executive Officer of the Asian operations in 2015. And as in 2017, he was chosen to lead as the CEO of the company as they went through this whole transformation of their business, and really didn't think there was anyone else better than him, the person that they had in charge of their Asian operations where they see the most growth. And then now we'll go into some of our peers. Joe's talk about that.
Yeah, so if you look at our peer table, the bottom 4, including Manulife, are based in Canada, and the last 2 are U.S. Life insurance companies. And the reason why we wanted to add those U.S. companies is, 1, it gives us some U.S. exposure, which we do have some U.S. exposure, and 2, it gives us a more conservative valuation, as the U.S. life insurance companies are valued differently. Our largest and closest competitor would be Sun Life Financial, where we do very similar things. We have exposure in Asia and similar business models in Canada. However, one of the big differences between us is that our technology growth is very different. For instance, Manulife has come out with an app since 2017 for users to use, and that's something that Sun Life hasn't gotten around till late summer of 2018.
Now I'd like to open the floor to questions.
I'm going to start it off. I'll follow up on the discussion of the peer. Our business in Asia, you mentioned it numerous times, growth market, driver, et cetera. How come no Chinese companies, life insurance companies in the peer group? You got Ping An, you've got China Life, and there's another major. So I understand
Sure.
the explanation of the peers you had, but why no Chinese?
Sure. So I think that Manulife has, the reason being is that these companies in our peer list do have Asia exposure, but I think that our company is able to, because we're closer, been in Asia for longer, it just shows our strengths. So, but we're very similar in other aspects of the business, which is why I think we wanted to keep the peer group the way it is.
Did you look at any of the Chinese?
We did, and honestly, it didn't. A lot of the companies were overvalued right now as they try to get into that technology sector and all these new companies coming in. A lot of investors are kind of wary of, Chinese insurers.
But that's not a reason to exclude it from the peer.
It's not at all, but it gave a more fair valuation of our company and actually brought our upside down a little bit, but it was a little more fair.
I have a risk question. Is that you?
Yep.
So like in terms of the low interest rate risk, how much like Asia revenues? What's the breakdown there, like country specific? So like is it coming from Japan, China? Where's the Asian revenue from?
They're Asian. They operate in 14 countries over there,
Okay.
so they don't break it down into
Okay.
specifically like that. But I think China offers the most for them.
Okay.
Japan, Philippines, and Hong Kong.
Okay.
Connor.
Yeah, thank you. Do you have any built-in interest rate assumptions moving forward, given that yesterday there was a cut? Doesn't that put a lot of extra pressure on the company?
It does as well, but we definitely kind of increased our discount rate for some of the near-term headwinds we're going to see there. And we're also expecting to see a leveling off headed into the second half of last year, but that's how we kind of accounted for.
And further for that, looking at Canada, they were one of the only places in the world to not cut rates on Wednesday, and they actually held their rate at 1.75 compared to the U.S. dropping it to 1.5. So.
That's good. Do you know what the yield spread looks like in Canada? The difference between the short term and the long term?